All right, so now the next topic we have is measurement of inventory subsequent to initial recognition. When you say initial recognition, that means we would have already recorded our inventory using the FIFO cost flow or LIFO cost flow or average cost method, or maybe the specific identification method. Once the inventory has been initially recognized, what do we do subsequently when the inventory value falls? Now, gentlemen, please, here is an important summary of what we do under the IFRS and the US GAAP. FIFO, we have already done. First in, first out. We have done perpetual and periodic. I'm sure you people would have gone through. FIFO is permitted under IFRS. It is permitted under the US GAAP. What we do in FIFO, I don't need to tell. I'm sure all of you know. Average cost, whether periodic or perpetual, it is allowed under IFRS. It is allowed under the US GAAP as well. Now, this is the problem. LIFO, last in, first out. This method of inventory valuation, it is only permitted in US and China under the US GAAP, that's what we are most interested in. But LIFO method is not permitted under IFRS. So make no mistake, LIFO is permissible only under the US GAAP. So you need to clearly see the information given, whether the accounting regime is IFRS or US GAAP, and then solve the question accordingly. Now, this is so far, FIFO is allowed under both methods, both accounting regimes, average cost under both. Last in, first out, it is permitted only under IFRS, under US GAAP, not IFRS. Now, these are the two rules you need to learn very, very well. Nrv and LCM rule. Where do we apply Nrv? Where do we apply LCM? Please pay very close attention. This is very fine. First of all, LIFO is something that is permitted under the US GAAP. This is something that will have a unique valuation method subsequent to initial recognition. So Nrv rule, it is applicable under all bases under IFRS. What is Nrv? I will explain just a little while later. Whereas in US GAAP, Nrv is applicable in all bases other than LIFO and retail method. For LIFO and retail method, these two unique methods, retail method is not in your syllabus, so we'll only discuss LIFO. So under LIFO and retail method, you will use a very unique rule called LCM. So in other words, just keep it in mind. For LIFO and retail method, we will use a method called LCM, lower of cost or market price. We'll discuss this in detail. So let us first discuss what Nrv is, what is the Nrv method, and what is the LCM rule, and then we will decide accordingly which method is permissible under which accounting regime. Further, you need to know, we are going to discuss all these. Whatever you're seeing on the screen right now, it is the summary, what we are going to do tonight. So just let's have a quick overview. Once the inventory has been written down because the inventory value has fallen significantly, IFRS allows you to reverse the write-off. Let's say in the previous year, you wrote down your inventory by $10,000. You charge it as a loss. Subsequently, inventory value appreciated by more than 10,000, maybe by more than 15,000, but you can only reverse the loss previously written off, not beyond the loss written off. Remember, whatever you wrote off previously, you can only raise it up by the amount written off. You can just reverse what you've already done. Under US GAAP, inventory write-down are not permitted to be reversed. Once you write down a loss, halas, finish. No more reversal. No more reversal under the US GAAP. So that is why you have to be careful. If the decrease in inventory value is considered to be temporary, then don't write off your inventory. You write down only when the fall is permanent, because once you write off, you may not be able to reverse. So be careful. Fine. Makes sense. We'll discuss all these as we go along. Wa alaikum assalam, Sadia. Admin and selling expenses, clearly they are not production cost, hence they are not included as a part of inventory under IFRS and also under the US GAAP. Similarly, abnormal spoilage, the loss that is not expected to occur in the normal operations. It is not made a part of product, hence it is excluded both under the IFRS and US GAAP. So what's the difference here so far? What we have written in this, given in the red blocks. LIFO not permitted under IFRS, allowed under US GAAP, and then the difference between NRV and LCM rule. Let us discuss these, and we will frequently come back to the slide again and again so as to get the ideas fixed. Let us see what is NRV rule that is applicable to most of the cases under IFRS and US GAAP. NRV says, NRV rule, that you keep cost on one side, cost of your inventory on one side, and keep the NRV to the other side. What is NRV? NRV stands for net realizable value. Net realizable value. And what it is? Net realizable value, ladies and gentlemen, please note, it is the final selling price, final sale price, minus cost to complete. Please write these small things down. These small things will make a difference. The small things the teachers tell you, please make sure you note this down. You keep this thing in head. That will help you get through. Net realizable value is equal to final selling price minus cost to complete, or if any, cost to sell. Right? Let me give you an example. An item can be sold finally at $100, but in order to sell it at $100, you will have to first complete by incurring $3. That is the cost to complete. And in order to sell, you may have to pay $7 additionally. So what you will get net $90. This is called net realizable value. You sell it at $100, but you may have to complete it because it's partly damaged or incomplete. $3 is the cost to complete, and $7 is the cost to sell. The net amount you realize is 90. This is called the net realizable value, or NRV, simply. What you do, you keep your cost on one end, and you keep your NRV on the other end, and see which of these is lower. Now, let's say if your cost happens to be $120, whereas the item sells for 100 but brings you a net of 90. Clearly, cost is more, NRV is less. Administrative cost, it is not included as a part of product cost. Yes, it's a selling expense because admin expense, remember the costs you incur in your production facility. Those costs are considered as a part of your inventory cost, inventoriable cost. Selling, administration, distribution, general expenses, they are not part of product cost. Jihar walaikum assalam. Ibrar walaikum assalam. I just saw your text. So guys, remember, if the cost is 120, but the item will only get you $90, this would be very, very unfair to keep your inventory at $120. This is unfair. This is overstating your inventory. You can't do that. You shouldn't be doing that. Be conservative in your estimation. So this is reporting at a higher price, whereas the inventory will get you only 90. So what I should do under this situation, I should take lower of cost or NRV. Since NRV is less, my inventory value is going to be now $90 per unit, not 120. I will have to book a $30 loss on inventory. This is what IFRS says. This is what US GAAP says. Under what situations? When the inventory is based upon FIFO or the average cost method. Average cost is the weighted average or the moving average. So these two methods, FIFO or the average cost method. In these two, remember, ladies and gentlemen, IFRS and the US GAAP, they are on the same page. And they tell you, compare your cost with NRV. If your cost is more, NRV is less, clearly, you cannot overshoot your inventory. So you need to write this down to 90 and book this 90 as a loss. The only difference is this loss under IFRS is reversible if the value of the inventory goes up. But if you write down this loss under the US GAAP, no reversal is permitted. This satisfies this part of your slide. Write down reversal is permitted under IFRS, only up to the amount written off, but under the US GAAP, reversal is not permitted. So if the inventory cost is more, NRV is less, you have to book this as a loss. Now let's change things a bit and then see how they needs to be taken if things are a little different. All right. Let's say if your cost is $70, FIFO or average cost, and your NRV is 90. Clearly, This time your cost is lower. Your cost is lower than NRV, so do nothing. You don't need to do anything because your cost is already less than the NRV. So please remember, you have to compare your cost and NRV. Whichever is lower should be the basis of your inventory valuation. In this case, cost is 70, NRV is 90, so we are going to go for the lower one. Cost is already lower, so we don't need to do anything. Yes, Ibrar, a reversal is allowed under IFRS only. Yes, in the subsequent period when the inventory value is higher, you can reverse the loss previously written off. So, gentlemen, let us do this. How do we do this? Let us do for each of these three situations. Consider IFRS and US GAAP on the same page. Consider this method of inventory valuation is either FIFO or the average cost method. Both IFRS and US GAAP are on the same page. Let us do these three parts separately. Stockholm Company accounts for its inventory using the first in first out method or average cost method. They're both treated same way under IFRS and US GAAP. The data below concerns items in Stockholm Company's inventory. We have the historical cost of three items: gear, stuff, and wickets. We have the selling price of these items given separately. We have the cost to complete and sell. Remember, cost to complete and cost to sell. And the current replacement cost means this is the price at which gear, stuff, or wickets can be currently purchased from the market. And the normal profit margin is what we generate as a profit when we sell these items separately: gear, stuff, and wickets. Now, forget about the questions requirement. Let us calculate the NRV and cost in each of these cases. First, let's take gear. For gear, the historical cost is 190, given right here. What about the NRV? We know NRV. NRV is the final selling price minus cost to complete and sell. 217 minus 19. That gives you 198. Now look at this. Now tell me, gear have a cost of 190 and the NRV is 198. We need to take the one that is lower. Since the cost is already lower, Rajesh, we are not going to do anything. Don't do anything. Do nothing. Because cost is already lower, right? NRV is higher. So we always take the one that is lower. Let us try the second part now. Remember, ladies and gentlemen, this is US GAAP, IFRS on FIFO and average cost method. What about the stuff? Let's do the stuff now. We have cost on one end, which happens to be 106, and we have the NRV on the other end. What is NRV? Selling price minus cost to complete and sell. 145 less 8, 137. Again, cost is less, NRV is more. We always take what is less. So in this case, we are not going to do anything, do nothing. Things are fine. We don't need to write down any loss. What about the third case? Wickets. For wickets, the cost is 53. NRV, which is final selling price minus cost to complete and sell, it is 2.5. So if you take the difference, 73.75 less 2.5, you get 71.25. Interesting. In all of these questions, cost is less, 190, 106, 53. So do nothing. So in case, had there been a lower NRV in any of these cases, we would have written it down as a loss. So remember, ladies and gentlemen, IFRS and US GAAP, they behave exactly in the same way if the inventory is under FIFO or under the average cost method. This is what we do. We compare cost versus NRV. What if the inventory valuation is, I think, let us do the question now. What amount should Stockholm Company compare with historical cost to measure the amount at which the wicket should be measured? Wickets is this one less, 71.25. Cost must be compared with NRV. NRV under FIFO and average cost method is given as 71.25, and this amount is already higher, so there's going to be no loss right down. That makes C to be the correct option. Right? Now, here we go. Now we have LIFO, last in first out. This method, ladies and gentlemen, is not permitted under IFRS. What do we do under LIFO? We have a totally different method called the LCM rule. This is little different than the previous one, because previously what we used to do, we used to compare cost with the NRV, and whichever of that was lower was taken as the basis for our valuation, right? But under LIFO, we keep cost at the one end, and we take the designated market price on the other end. Designated market price on the other end. And what the market price is going to be, that's the tricky question. Market price is the middle number of these three. What three? First, you will take NRV, then you will take the replacement cost, and then you will take the NRV minus normal profit margin. Plug in the numbers in these circles. Whichever of the numbers given here is the mid number will be the amount with which you will compare a cost. Let me repeat, it's not difficult. Previously, it was just simply cost versus NRV. LIFO under the IFRS LCM rule is little twisted. You keep cost on one side, you take your designated market price on the other side. What is the market price? It is the middle of these three circles, middle of these three, middle number of these three. Whichever these three numbers are filled, whichever is the middle will be considered as your market price. And you compare your cost with the market price, and then you decide, should you write down your inventory or not, right? What he has given, I do not recommend this method. You go for the ceiling or the floor. It works in the same way, but it is little twisted. What my recommended approach is, forget about what the book says, what Gleim says or Hawk says. Listen to me while I'm telling you. You will get every question wrong. Follow my approach. Take cost on one side, take NRV, replacement cost, and NRV minus normal profit margin on the other side. Take these three bubbles and take the one that is the middle number. Compare that middle number with the cost and see whether that middle number is higher or the cost is higher, and then decide accordingly. So I'm just going to skip everything that is here. I don't like this method. This is too twisted. Sometimes you get confused between the ceiling and the floor. Just follow the bubble approach and it will help you solve the question. Now, ladies and gentlemen, consider this is LIFO and you are preparing your accounts under the US GAAP. Now, what you're going to do, you're going to do the method I just told you. First, you're going to take gear. You will take cost on one side, and you will take these three bubbles on the other side. And what these three bubbles are, you have NRV, you have replacement cost in any order, doesn't matter. Just put these bubbles in any order. NRV minus then replacement cost, then NRV minus normal profit margin. Okay. What is the cost? Historical cost of gear is 190. Put it right here. Okay. What about the NRV? We know NRV. NRV is simply selling price minus cost to complete and sell. 217 minus 19, it's 198. Plug it in this specific circle. Then what is the replacement cost? It is given right here, 203. Okay. What about the NRV minus normal profit margin? NRV is already there, and you have to deduct this 32 as your normal profit margin. So it's going to be 198 less 32. It's going to be 166. All right. Now tell me, which of these is the mid number? This is too low. This is too high. This is the mid number. Right? Take the middle bubble, whatever it is out of these three. NRV, replacement cost, NRV minus normal profit margin, whichever of these bubble is the middle one. Do your comparison between the cost and the middle number and take the one that is lower. Which of these is lower? Which of these is lower? Clearly, cost is lower. It means we don't need to do anything with gear. Things are perfectly as they should be. Cost is less than the designated market price, which happens to be the middle bubble, is higher. So I'm not going to do anything. Everything is perfectly fine. Yes, Ms. Yumna, you're absolutely right. We'll keep the item at historical cost of 190. Now, let us move on to the next item, stuff, and see what we can do with it. All right. So for stuff, let me write down the stuff again. Here we go. This is stuff. You keep cost on one side and you keep the designated, I call it designated market price, DMP. That's the exact word used in the US standard. Yes. Now let's write down these three bubbles. in any order. Let's take replacement cost first. Let's take NRV here and take NRV minus normal profit margin. So in this case, your cost is 106, put it here. Your designated market price is going to be middle number. Replacement cost is 105. NRV, that is selling price minus cost to complete and sell, that is 137. And NRV minus normal profit margin, 137 less 29 gives you 108. Now, in this case, which is these is middle number? 105 too low, 137 too high, mid number is 108. Correct. So you are going to compare your cost with the mid number and take the one that is lower. Since the cost is already lower, we don't need to do anything. Don't do anything. Everything is perfectly fine. You don't need to write off any loss. Absolutely right. So things are good so far. Let's see what is the situation for wickets. For wickets, you keep your cost on one end, which is 53. You keep these three bubbles on the other end. One is the NRV, other is the replacement cost, and then NRV minus normal profit margin. NRV 73 minus 73.75 less 2.5, it is 71.25. Replacement cost is 51, and NRV minus normal profit margin is 50. Now, which of these is the middle number now? Too low, too high. This is the mid number. This is the mid number, ladies and gentlemen. We finally got the culprit now. Your cost is 53. Your designated market price is 51. We need to take the one that is lower. In this case, 53 versus 51. This is going to be your new value of your inventory. You are going to write off a loss. 53 less 51, $2 loss per wicket. This is a loss that you're going to charge in your income statement as a loss for the period. And this loss is irreversible. Under the US GAAP, once you write down this loss, you cannot reverse. So please be very careful. If the decrease in the price of the goods is temporary. Yes, sure. See, look at this. Our historical cost is 53. Let me highlight the specific parts. Our historical cost is 53. The designated market price is the middle circle or the middle bubble. Our NRV is 71.25. How do we calculate 73.75 less 2.5? Our replacement cost is 51. And our NRV minus normal profit margin, it is 71.25 less 21.25. That gives you 50 as your NRV minus normal profit margin. We have to select the one. We have to select the one that is mid number. This is too low. It's the lowest part. This is the highest part. This is the middle part. We need to take the middle number. 51 is the middle number, right? We compare this middle number, 51, with the cost, and out of these two, whichever is the lower would be the base now. Since cost is 53, the mid number is 51, so the new basis for our inventory valuation, Mr. Humana, is going to be 51. So we will write down the loss as $2 per unit. All right, so that makes the story. Please remember, ladies and gentlemen, LCM rule that I've just explained is applicable only under the LIFO valuation and the retail method. And all the other methods, you're going to use the previous method called the NRV versus cost, whichever is lower, right? Now, let's try this in actual question. It says the following data applied to a unit of inventory. Your selling price is 22, selling cost is 2, normal profit margin is 5, replacement cost is 10. Using the lower of cost or market price method of measuring inventory, what is the market amount, or what you call the designated market price? You just have to find out the designated market price. It's a very simple thing. All you need are three bubbles, one with the title NRV, other is in any order, NRV minus normal profit margin. NRV happens to be selling price minus cost to sell and complete, that's $20. Replacement cost is given straight away, 10. And the NRV minus normal profit margin, 20 less 10, 20 less 5, it's 15. Take the one that is the mid number, the middle one. So 10 is too low, 20 is too high, this is the mid number. So this is the designated market price, and this is the amount with which absolutely all of you got it right. Excellent. Excellent. So that would make B to be the correct option. Answer: retail method is the method of inventory valuation used by the merchandisers, those who just purchase and sell. And this is not included in the text. So just remember that retail method is one of the methods on which you apply the LCM rule. LCM rule is applicable on retail method and the LIFO. All righty. Next, interesting part now. Applying the load of cost or market or NRV. If you want to compare cost versus the NRV or cost versus market price, there are three approaches. You can use this method in three different ways. First, you can calculate cost versus NRV or the designated market price. Remember, NRV is used for first in, first out method and average cost method, and the designated market price we use for LIFO and retail method. So cost versus NRV can be applied on every single item separately. You will calculate the cost versus NRV or DMP for printer, for computers, for fax machines separately. This is the first method you can use. Apply LCM or NRV to each individual item in inventory, such as printers, each item sum one by one. Second way is that you can apply LCM or NRV to each group of items. Each group of items could be, maybe you have different types of items, group A, group B, group C, or all the printers, all the computers, and all this. So if you go for grouping, groups of inventory item, you can apply LCM or NRV rule on groups of inventory items as well. And the third alternative is apply LCM rule to entire inventory. You take entire inventory's cost, you take entire inventory's NRV in case of FIFO and average cost method, and designated market price in case of LCM rule that you apply for first LIFO and the retail method. So you can apply this valuation on entire inventories, your choice, but you need to know what difference would it make. Now, try doing this question. This is the question you will do yourself. The load of cost or market value of inventories may be applied to total inventory as a whole, the groups of similar items, or to each item separately. Of course, it will be time consuming. Which application generally results in the lowest inventory amount? This is a question for you. Absolutely right. You got it right. Excellent. If you apply this for each item separately, item one separate, two separate, so all inventory items will be there at their lowest amounts, which means the total inventory would be lowest. Absolutely right. All of you got it correctly. This is the right option. Right. Next. Now, once you have identified the loss, whether using the LCM rule, NRV versus cost, you need to write down the loss. How do you do that? You write down loss on write-down of inventory, let's say $10,000, and you credit the inventory. This is the loss reported under the period. What you can do subsequently, this loss can be reversed under IFRS if the value of the inventory increases. But if this loss has been written under the US GAAP, there is no reversal. Maafi reversal. US GAAP is little stringent. US GAAP will not allow any reversal of the loss. So this is an important point you need to remember. Let us try this question. A distribution company has determined its December 31st inventory on LIFO basis. Whenever you see the word LIFO, you immediately should recall the concept where you compare the cost versus the designated market price. And what is designated market price? It is the middle of these three circles. Let us apply this. So we have cost on one end, that is $200,000. We have the estimated selling price 204, estimated cost of disposal, sale price minus cost to sell. That will give you the NRV. So I'm going to put it as NRV 194, omitting 3 zeros. Then the next part, let's say this is the replacement cost. Let's say replacement cost is given as 180. Okay. What about the third bubble? This is NRV minus normal profit margin. So NRV is already 194. 194 less normal profit margin will give you 164. Okay, now we need to take the middle bubble. It's too low, it's too high, not too low, not too high. Take 180. This 180 needs to be compared Absolutely, Mr. Meena, you're right. This 180 needs to be compared with the cost. 180 is the replacement cost. 200,000 is the current cost in our books. So clearly, there is a $20,000 loss which you need to write down under. The question is silent. The question is silent. Can anyone tell me whether it is under the IFRS regime or is it under the US GAAP? Absolutely, Ahmad. And this is absolutely because LIFO is permitted under the US GAAP. It is not permitted under the IFRS. So, ladies and gentlemen, this $20,000 loss needs to be written. The company records losses that results from applying the lower of cost or market rule. At December 31st, the loss that the company should recognize is $20,000. And this loss, ladies and gentlemen, is not reversible. That's an important point. Okay, here we go. Which of the following is true regarding the inventory adjustments under the IFRS? IFRS do not require inventory adjustment. It does. It does. You compare your cost with the NRV and then you do the adjustment. So this is incorrect. What about B? Reversals of adjustments are allowed in the subsequent period. Yes, correct. IFRS allows reversal. So this statement is true. So do not just jump. You need to convince yourself that you got A correctly. It's wrong. You need to be able to identify C and D. You need to convince that you are getting the right option. So why not C? Let us convince ourselves. A reversal of previous write down may be higher than the previous write down. Wrong. If your previous write down was $10,000, your write up should be of $10,000, not more. Reversal cannot be more than the write down. This statement is wrong. And it says that adjustments may not be reversed in the subsequent period. This is not true under IFRS, but it is true under the US GAAP. Right? So that completes your topic.